Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. All right, Zane, sitting here on January 17th. Good to see you again. We had Sarah on last week. Great episode for those who haven't listened to it. Talked about some crude differentials, sanctions, but we have some more to discuss this week. How's it going?
Good. Good to be back. I missed you last week, Alex. Thanks for finding somebody very interesting as a stand-in. Or maybe I'm being replaced. Either way, it's all good stuff.
Got a lot of talent to pull from, so we're never safe, either of us. But I think this week we have, a few things in regional natural gas, kind of broader natural gas, and several things in crude markets. Where do you want to kick it off?
Well, I feel like we give crude more attention than it deserves. Sorry, crude market, and natural gas has been kind of a rather benign and or boring Q4. And here we are in the early days of Q1 25, and it's a much more exciting story. So let's start with natural gas. I don't know. You want to pick the topic and pull my string, or you want to have me just run with it?
Let's see. So I think I've got some questions on the regional cash going on right now, but if there's any preface to that with what's going on with weather or kind of broader themes that can help you zone in on the regional, maybe kick it off where you want.
Sure. I mean, I don't think it's a very well-kept secret at this point. It is colder than normal almost everywhere. So cash markets are certainly reflecting as much. I think it's important to just back up a little bit and help listeners gain some context for the differences between extreme momentary cold and sustained, maybe not so extreme cold. And, for a placeholder there, I'm not saying next week isn't extreme. It is certainly that. But if you go back to early in the year, meaning, just past the holiday season and early last week, there was some, significant run-ups in BALMO pricing or balance of the month daily markets. Sorry, that's probably a rabbit hole on its own. Maybe we'll cover it in a future podcast. But the market began to appreciate and understand that this cold wasn't going away after the brief hiatus over the Christmas New Year holiday, which led to 1 week, which was actually record-setting warm. And then here we are on Friday the 17th, trading for a 4-day cash or spot market package because of the MLK holiday on Monday. And the cold that's coming in will be, I think arguably round 2, some might say round 3, calling last week cold, or the week that ends, I call it last week because I've already moved on to the EIA reference week of Jan 23. But the one that's ending now was certainly not warm. It'll be our second 200 plus withdrawal, maybe a similar 250 like level. And what's upcoming, where, your, I guess, initial question, regional markets. So just looking around the country at where physical markets are trading today, certainly opened the early AM hours with some of the strongest prints. The hub was over $10 early in the morning. It's kind of stayed around that level, $9.50, $10. And again, that's Saturday through Tuesday delivery. And we'll jump to the left side of the country or the West Coast first, and then move back across east. We'll go less exciting to more exciting. On the West Coast, still, while the draws have been meaningful in the West in the past couple of weeks, there's still a lot of gas laying around. So SoCal Citygate, for example, trading well under the hub at around $7 for that Saturday to Tuesday package. And where that becomes even more interesting as you move back slightly to the west and stay along I-10, you get into West Texas or the Permian, and we started out the morning around $8, and we're down to around $6.50, late morning trades. So certainly the early morning excitement has faded. However, a 50-cent spread between Waha and SoCal is not something that's been seen too often. So you say, why? Well, clearly there's one of two things, and they kind of go hand in hand. We're freezing off some Permian production, or we're expecting to, that is. and that supply is not going to be available, or markets to the east. And again, they go together because if you're freezing places off, markets to the east are going to have to price higher in fighting for some, the MMBTUs that are available to serve demand in this peak cold. A little further to the east, Houston Ship Channel, how has it fared? We'll start of the morning pretty similar to Waha. Started around 8, is down around 6. So there's some interesting things going on there. Waha over Ship Channel. And those are just kind of last trade sort of levels. So, we'll end up seeing once the prints are finally in what the VWAPs for the day are. Point being, we're certainly quite a bit higher. I'll kind of move back into the western side of the country for a moment, and we'll look at CIG. So you've got the Rockies trading around $7-8 as well. So there's kind of this parity around, call it $6, $7, $8. And then as you move to, some of the really core demand markets in the east, specifically, I'll pick on Transco Zone 5. This morning, it printed a high of $42 in MMBTU. It's down to $39. And you can see where these pockets are that really struggle with deliverability with this kind of cold. In Appalachia, I don't know, it's almost like the comedy of when markets don't know what to do. They just all follow each other. Start of the morning, a little under $9. Last trade's around $7.50. So you kind of keep hearing this $6, $7, $8 sort of range. Yeah. Columbia Gulf Mainline or Perryville, a key marker for the Haynesville producer, printing around $9. So similar to the hub. Once we get into the cold next week, although spot market's currently trading for Saturday through Tuesday being the coldest day of the upcoming week, it's not like Wednesday, Thursday, and Friday are going back to an outright heat wave. So This is that, sorry, I'm kind of going on a bit here, but this is pretty important what I wanted to arrive at. Sustained cold does, and you think of this in just the kind of logical, practical, how does the physical system work? Well, when the demand is pulling gas off the pipe at an increasingly rapid rate, then the pipes have to pull from storage harder to make sure that they are pressured enough to meet deliverability needs. And that's where that sustained cold comes in. And it's a storyline that we'll probably be revisiting, again throughout the month of February and maybe even March, unless it is a complete pattern flip. Even if we go back to normal weather, because the pipes have been pulled on so hard, you can have weekly storage withdrawals for weeks following the peak cold that's surprise to the high side, simply because you're having to refill these pipes. Just like when you get early cold in the year, let's just say November, December cold, often those withdrawals are disappointing because how much is actually on the pipe already.
Right. That's not really something people think about often, is what is the capacity that's on the pipeline itself. And when you're pulling harder, you have to obviously backfill that. Is there any concern in the next week of cold about freeze-offs?
Oh, for sure. I mean, we're, already, kind of lingering cold from the first full week of January. We haven't gotten back all that we lost that week. I've seen estimates that range from 3 BCF a day up to a little over 10 BCF a day when we reach the peak of the cold. I don't know that anybody really knows for sure what it'll be. Point is, supply gets lost while demand goes up, and it has a profound impact on spot pricing. Yeah. Does it have an impact longer term? It really shouldn't, because a molecule that's not available today because it's stuck in the ground because the system won't allow it, it does come back. And often when it does come back, when things warm up, it's greater than expected. You think of like overpressuring something. It was meant to flow freely. It's held in the ground, and that pressure builds up and builds up and builds up, and the term gets used as flush production. So it jumps, and, so you can certainly see that, when we get a material warm up, if we get one, production will surprise to the high side momentarily before settling back down, creating a great deal of confusion about what to expect going forward.
And those cash prices that you mentioned for today, around $7, is that, I guess, where is that relative to the recent trend over the last month or so?
Oh, we spent a lot of Q4 in the kind of boring, pick your market. The spreads were a lot wider. You'd have Waha would still trade negative. You'd have the hub trading, $2.53. So, most everywhere is, in this peak cold is up, $4, $5, $6. And then, you get those really peaky locations like Transco Zone 5 that are, tens of dollars higher.
It's just been a minute since we talked about Matterhorn. I think we talked about that a while back, but what have kind of been the latest updates since Matterhorn's been online? And I know we were talking about Houston Ship Channel versus Waha and how that's been connected or disconnected. Is that starting to
there's a big difference between the way the physical market's trading and forward markets are trading. I think the expectation that Matterhorn coming online was going to flood the Gulf Coast with too much supply, Permian to Houston, really is not borne out. I mean, for the most part, other than very mild, very windy days, Houston Ship Channel has actually fared better than the market expected relative to the hub. And forwards for Houston Ship Channel have certainly improved, and Waha momentarily did. If you go back to late Q4, there were some times where the very front of the Waha curve was, 40, 50 cents better than it was, not that far in the distant past. Right. And what that brought on was some material selling by the Permian producer. And with NYMEX rallying, it has just magnified that trend where Waha is, the front of the Waha curve is getting, when I say front, really even out through Cal 26, has gotten absolutely hammered. And so one might say, well, look, Matterhorn wasn't enough. Look how bad Waha is. Well, that's trying to fit a fundamental story to a price move, where it may simply be that the Waha producer or the Permian producer with better NYMEX pricing, and for some context, the Bal 25 strip, about a dime under the $4 mark. So, let's just call it $1 better than the low, is, offering something that combined with the Waha basis improvement was much better than a West Texas producer could have done. Mm-hmm. And so, you've seen those move in opposite directions. I think the jury's still out. Will there be, is Matterhorn enough for now? In some ways is a function of crude pricing. Does the crude market, does the TI curve bend such that it calls on more U.S. supply without incremental crude production? Matterhorn is, I would say, well, I'll just put my name on the line here, is plenty for now. With incremental crude production, that changes.
Yeah. Yeah. And as you mentioned, bumping up over $4 for a while, we've been talking, really, you have been talking about the disconnect between weather adjusted inventories versus kind of just headline raw number. Is there a little bit of an awakening happening right now? What's kind of going on? What's kind of the big thing driving Henry Hub right now?
It's hard to say. Your question, is it the market acknowledging that we've been undersupplied on a weather adjusted basis? Certainly the curve is flattened. Bal 25 is almost flat to Cal 26. And there was 50, 60 cent spread almost at one point with Cal 25 under. And so the curve is flattened. Some of the incredibly steep contango has finally been taken out. I would say that it's probably not any recognition or acknowledgement by the broader market that we're undersupplied on a weather adjusted basis. It's more just the weather forecast. Mm-hmm. And that's like an important thing to flag too. If it hadn't already been stated, it will in short order, but there's going to be plenty that will just say, well, it was just because it was cold this winter. That's the only reason we ran up. Otherwise we'd still be $253. And I will raise my hand for a moment here and say, we actually have not been cold, even including the forecast. If you take the realized temps from November 1 through January 16th and take the 15-day forecast from today forward, and you compile all that for an HDD count, you're still about 50 HDDs warmer than normal. And yet, season-ending inventory levels have been plummeting. Right. So I don't know that it's really been acknowledged yet. I think we're just in this state of confusion as we're transitioning from what were two materially warmer than normal winters in a row, and really a streak over the past 7 years of that being the theme, to something less warm. And because we are not yet in a colder than normal winter. And yeah, I guess an important point there, if it were to stay cold through even just the month of February, certainly for the balance of winter, then inventory levels would fall well below 1.5 TCF for anybody that was authentically considering the, as you mentioned, underlying weather adjusted balances. And at that level, you start looking at the summer build prospects, and it gets very difficult to come up with a rational path to even 3.7 TCF. And, for many that are really picking apart the details, is like, well, how much over 3.5 will we be? And so, you put all that together and it's, well, if my withdrawals are bigger than my injections, I got a problem, and it has to be solved through price.
Mm-hmm.
And, it's Mother Nature is, so I guess in conclusion, Mother Nature is why we're doing this.
Right.
And she can take it right back out in a hurry. Before this winter is over, though, there will have to be some acknowledgement of weather adjusted balances, simply because at this point, it cannot be completely overwhelmed by weather because we're too deep into the winter. Here we are, it's the middle of January. We've got a 15-day forecast that all 4 major weather models say will be colder than normal. So there's some, cohesion there. So we'll be through the month of January and we'll be near normal. So with 2 months left in the winter, almost regardless of the severity of the warmth, if the forecast were to completely capitulate, it will not be that material for this winter. So the dust will clear, and I say, well, where are we and how did we get here? And what does that mean about what we think going forward?
Yeah. Yeah. And looking at the last 5 years or so, kind of the numbers that I can see quickly, the bottom end of the season ending balance, you have about 1.4 TCF. Is that about right?
Yeah, that was winter 21-22. So before the global BTU crisis really ensued. And that's an important one. Like if you think back to that time, because another question that's gotten asked by clients quite a bit lately is, what are producers going to do now that prices are higher? Well, if you go back to end of summer 21, meaning before winter 21-22, we were about 3.6 TCF. And we ended up at 1.4, just using kind of some rounding there. So it's pretty quick and easy math, about a 2.2 withdrawal. And that had the market in late 21. So before we got the winter 21-22 drop down to 1.4. And I think the market kind of forgets this. It's overshadowed by the highly elevated price levels that we saw in 2022. Towards the end of 21, we were already over $5 at the front of the curve. And I think that gets kind of missed. It happened in a hurry in the second half of summer 21. We were undersupplied. It became a problem. The world could not really solve it through price. And then late 22, we started to see the production response. But then winter 22-23 was materially warmer than normal. So it's like, look, see, you solved it. Prices went too high. Maybe it was just because it was, I believe that was the second mildest January, Jan 23, and since 1950. So,
Yeah, as you say, Mother Nature's in control for sure, because it could have just been the opposite end of that as well. Yeah. And during that time also you have Europe and Asia struggling with their supplies. And is there any relationship, I guess, between, what's going on in Europe right now? I know it's been a little bit mild in Europe as well, but we've still had, some stickier prices for TTF despite the warmth after the Russia pipeline expiration that we've already discussed. We don't need to go into that, but is there any relation?
Not yet. I mean, TTF and JKM are both kind of hanging around the $14 mark. In some ways, it's, interesting. You've got regional markets in the U.S. Some of them are pricing up to essentially TTF minus transport, call that 10, bucks, $10 to $12. So in theory, it's, bumping up against the arb to get to Europe. If we stay cold, we'll probably go over it and LNG will fall and it will help solve the problem. And, I guess like the bigger picture, what do we think of European gas markets? I don't think we're going to know for another couple months. I mean, you've covered this in great detail in some of your market research reports, but, the inventory drawdown so far in Europe has been at a much faster pace than either of the past 2 years. Hasn't been as warm. You've lost the pipeline, like you mentioned. So we're about the middle of the 5-year range. But the path in January has really been similar as the path last year. The withdrawal rate is almost identical. And so that's the reason why I say, I don't think we'll know for another couple months. Last year, February and March, there were very paltry withdrawals in Europe. And if that divergence occurs again, like we saw in November, December, meaning faster withdrawal rate year over year, we fall to the bottom quartile of where we've been the past 5 years, then you can see TTF really start to move on the upside. And then what does that mean if it, gets cold again or stays cold in North America? Do we have to track it and follow it?
Right.
Pure economic theory would say yes. And, markets are irrational longer than most can stay solvent.
Right. Yeah. Big concern in Europe then is just how are we going to get supplies for 25, 26, first year in decades without Russian pipeline gas through a few different areas. But I think that'll be interesting to discuss when we get to that point. How about we move into some of the crude market themes from the last week and a half or so. We can start off with the U.S. sanctions on Russia's tankers that seem to drive quite a bit of response this week. I'll break down the headline. Treasury Department added sanctions in the last minute of the Biden administration on 183 vessels, 143 of which were tankers that, according to ship tracking vendors and some data that we have seen, account for about 40% of Russia's seaborne crude exports. So who does that affect? Really affects China predominantly. So I can pull up a quick number here for the actual share or estimated share. But the impact to China is, we have about 50% of those exports going to China. And those sanctioned tankers were responsible for about 60% of China's seaborne imports. So again, affected tankers are responsible for about 60% of those seaborne imports of Russian crude. And India is another pretty meaningful share. But, I think one of the downstream reactions that we covered this week in the research that was interesting is just how that affected tanker rates. And on the Middle East Gulf to China route for very large crude
carriers.
VLCC, very large crude carriers, thanks. VLCC tanker rates for February jumped about 44% from January 6th to January 15th. And they came off a little bit yesterday, but that equates to about a $4.1 million rate for a full VLCC, about 2 million barrels to China. So, kind of takeaway for me is really just you are adding the largest package of sanctions on Russia's tanker fleet since the start of the Russia-Ukraine conflict. And who does that affect? China and India predominantly. A lot of the Asian markets that have been importing sanctioned Russian crude are now going to have to turn to alternatives. That leaves the Middle East. But, I think there's also some interesting dynamics that we can elaborate on with the imminent arrival of the Trump administration and the tariff threats on those same countries and what that might mean for U.S. energy exports. But I guess, threw a lot of things out there. I want to kind of get your take on what you've been watching and maybe some other themes that I did not mention.
Yeah, I think that the tanker rates is a really interesting one. So it becomes more expensive to get the barrel that you're willing to get, meaning a non-Russian barrel. So let's just pretend for a minute like this really does strand Russian crude in Russia. It's got nowhere for it to go. Well, part of the increase in tanker rates has also been this kind of quietly in the background increasing price of diesel relative to crude. So domestic diesel cracks going up. It's not huge yet. We've gone from, let's say $25 or a little bit under up to just under 32. So not immaterial, but not this jarring, move to 40, 50 like we saw in 22 and so even stuck around through a big part of 23. But you make products more expensive. Crude is more scarce. Crude is more scarce as well. And it becomes more expensive. So who's the winner? Who's the loser? The idea that Russia is going to really be penalized by this, possibly. But do they get to sell their product through some back channel? What they're refining, do they just keep it and come out on the other side of whatever higher price environment this might imply? Certainly a possibility. I think the biggest loser is Europe. Although they say they won't buy it and haven't been buying it, we know that that's not true. They, just like China and plenty of other countries, we'll take a Russian barrel, just not the one that says Russia on the side of the boat.
Right.
So, I think everybody loses in the end. Ideally, it would benefit, and this is, kind of tying it together with the Trump inauguration on Monday, which I don't know, without getting too close to what would be an incredible hot button, Trump, seen as a bigot and a racist, inaugurated on MLK Day. I'm not going to say anything else, but man, that is interesting. Sorry, I'm always the one to bring up the topic that no one else wants to talk about. Okay. Moving back to the world of energy, if the U.S. could export more barrels, then it would be a huge benefit. Go sanction everybody. Sanction Iran, sanction Venezuela, tariff Canada, and go America. We'll make it great again because we'll send all this energy around the world, make a bunch of money doing it, make everybody more reliant on us, and create deeper partnerships. But that's not possible. We don't have any incremental export capacity. So, I think it's just creating a lot of confusion, high level points. Sanction Iran and Venezuela, drop those barrels right back to sanction lows. You backfill it with OPEC. Is there a partnership that gets developed between OPEC and the incoming Trump administration? Watch for Air Force One making a flight over to Saudi Arabia and a sit down between he and MBS. That would be an interesting topic to follow. And what we can see, and just kind of adding some color to what Alex and I have covered so far, is there's certainly been a material rally above the front of the Brent and the TI curve. Front of the TI curve goes over 80. Front of the Brent curve makes a move towards 83, doesn't quite make it. But more importantly, we've seen a significant increase in backwardation. For context, the month 1 versus month 12 spread, about $9 right now for TI. That was as little as, I think, $2 in the middle of Q2. The Spec community will often trade June or December spreads. The June red June, or June 25 versus June 26 at about $6. Certainly more than double where it was in its lows. Dece red Dece, $3.20. So we've gotten some shape back in the curve, which is also an interesting topic, because what does OPEC really want? Or maybe what do the Saudis really want? In a perfect world that the Saudis could control the market, and they've certainly done a great job of supporting it the past 2 years, the Saudis would want an incredibly backwardated curve where the backs, meaning say year 2 and beyond, were below a level where the Western Hemispheric, more specifically the U.S. and the Canadian producer, could not afford to borrow to drill. And, are they capable of doing that? In some ways, the incoming Trump administration could do just that. And, I think the Russian sanctions you pointed out, along with the, Trump euphoria, are what's driving a lot of this. And then quietly in the background, the most important point, we kind of started today's podcast, what do we want to talk about? What is the big thing? I think the big thing for the crude market that's not conjecture or speculation is global inventory levels. U.S. crude stocks, global floating stocks, to a lesser extent, but on the same token, European crude stocks, they're low. That can change in a minute with OPEC barrels returning, which isn't supposed to be the end of Q1. But for now, that low inventory level is a very real thing that is likely having an impact on those that got too short at the end of last year.
Yeah.
And then too short. But what does that mean? How does a spec get short? A spec will often sell the front and buy the back as a way of exercising that view. Which is also an interesting thing. So when that has to be unwound, if the market starts to rally on a bearish trade, which is a bearish spread trade, then you are buying the front and selling the back.
Right.
Which feeds right into that thing that OPEC would love to have. Back goes down, front goes up.
Right. Yeah, we had some pretty interesting spec positioning over the last 6 months or so. We hit record lows for net spec length, so length minus short interest for Brent. I can just kind of list them off. I guess ULSD or diesel, heating oil, gas oil, and WTI didn't quite have the same skew, but it was still quite low for spec length for a while. And we've seen over the last 4 weeks, that came off quite a bit for, combining all of the crude complex for the major contracts. We had 10-year 6th percentile for net length on December 10th. And in the 4 weeks since, that's jumped up to just shy of the 40th percentile for the latest, or new update today, but previous update for Jan 7, 40th percentile. And where has that come off? There's been a little bit in the heating oil side, but then also for WTI. WTI has jumped from the 7th percentile to the 57th percentile over that period. So, does that kind of fit into where you're watching? And then also, how does that curve structure fit into the outlook for OPEC barrels for 2025 through 2026, I guess, kind of the unwind phase that they're thinking about? Do you think they bring that back on, or do you think this is kind of the perpetual slow playing?
I don't think it's imminent. End of Q1 is what's predicted right now because that's what was stated last. To have barrels come back sooner than expected, I would imagine you'd probably need to keep Brent hovering near $85 a barrel for several weeks. Maybe a little under that level, but going up with a one touch, that's exciting and all, but that doesn't do it. I mean, some of the, smartest heads in the, global crude markets, they know how quickly the market would backpedal on a short-term rally if they were to even hint. If anything, I think it could go the other way around. They could see this rally as the market shifting its prevailing bearish sentiment and actually extend it for another quarter.
Yeah.
Because there's nothing to keep you from making the public announcement. Things are looking better. We see inventories at a level that make us feel like our barrels are wanted again. But just to be sure, we're going to go ahead and extend another quarter right in the middle of the rally to press it even further.
Yeah.
And then that's when I think you would be more likely to see them return early. Right. I could see an extension through June and a mid-March return be more likely than just kind of wait and see in a mid-February announcement, even if the market were better.
Yeah, or even just saying we're only going to bring back, a fraction of what we said we were going to bring back, and just extend the rate that they've kind of outlined so far, just extend that even further. So definitely an interesting one to watch there. I think I will recommend anybody who's interested in the sanctions on Russia to actually go and just take a listen to what we talked about with Sarah last week regarding the potential reinstatement of sanctions enforcement on Venezuela and Iran, what that might actually mean on a more local level for the U.S., given our refinery infrastructure, our transportation infrastructure, and then some even, other broader dynamics of how the Canadian TMX pipeline expansion fits into the broader picture, how Mexico's Dos Bocas refinery, hopefully in 2025 is what they're saying, how that would affect the U.S. and the U.S. refinery preferred slate of, I guess, what has historically been on the heavier end of the spectrum. But really some interesting stuff to dig into when you're looking at the crude differentials. Do you have any thoughts maybe to add to what was discussed or with Sarah last week?
Well, first, admittedly, I got to go listen to it. Sarah, I'm apologizing to you publicly. I haven't listened to it yet. I want to pause for a minute real quick before covering any of those topics and acknowledge the fine chess move played by the Biden administration in its final days in office with the Russian sanction move.
Mm-hmm.
It is, pretty clear. Increase the pressure and the sanctions on Russia because it's viewed that Trump and Putin are good buddies. And so what do? You stick to the sanction regime that the Biden administration left you with, and it raises energy prices globally, and it becomes your fault because everybody forgets when it happened, the minute that you take office. Or you go and you soften the sanction regime, and what gets more airplay? More global barrels on the market and lower energy prices for the American consumer or anyone else, or you playing nice with Russia? And I'm going to say it's the latter for sure.
You can see the headlines already for sure. And it's also related to that chess move. Some of the executive actions or executive orders, that have gone out in the later half of the Biden administration actually made it so the sanctions that were just rolled out on Russia will require Congress to pull back to their fullest extent. And so it really limited the operating room in a lot of ways too, potentially kind of forcing the hand or forcing a direction. And so it'll be curious, but you can definitely see the headlines already that would be discussing that framing.
So, but back to the question, there's other places in the world. I think TMX, Venezuela, West Coast of the U.S., Canada to U.S., there's some interesting dynamics there just in the Western Hemisphere, as if it were, the only place where people consumed and made oil and products. The TMX pipeline has led to a significant increase in the West Coast appetite for that barrel versus a South American barrel. And it's been proposed that an imported Canadian barrel by water, or for that matter, even an exported barrel by water from the Gulf Coast, does not suffer the same tariffs. So how would that work? If we can't and won't attempt to pressure the barrel leaving the West Coast of Canada to somewhere else, even the U.S. West Coast, no impact. If in theory, the barrel that is piped with some blended condensate from Western Canada all the way down to the Gulf Coast and then on to some other destination further afield is not sanctioned, what does that leave? It's the upper Midwest refining complex that draws a significant amount of Western Canadian crude to make product for the upper Midwestern refinery or upper Midwest product consumer that would be most at risk of an impact, which is pretty fascinating. Does that lead to significantly higher product pricing in a part of the country that has been, I guess, the epicenter of the, let's call it the political debate? If you've paid attention at all in the last 2 to 3 presidential elections, you've probably never known as much about Wisconsin or Michigan.
Right.
For those that don't reside in those states, it's not exactly this big tourist destination that's always in the news, and you always, everybody's dying to get there. So and my personal view is it's the consumer in the upper Midwest that would end up bearing the brunt of the Canadian tariffs. And then in regards to sanctions on Venezuela, it kind of punishes the West Coast consumer. And along the West Coast right now, certainly in the LA area, obviously, the concern is not so much product pricing. It's the just terrible situation with the wildfires.
Yeah.
And what that's doing to hydro reserves. We're using up water at a unbelievable clip to put out these fires. And so, I think it's both areas, the upper Midwest and the West Coast, are not in a great situation, both from what's happened either naturally occurring or man-made. I guess the debate's still out on the West Coast, and what could be unfolding in a man-made way in the upper Midwest.
Yeah, it is pretty fascinating just to be able to bring the global, a distant country like Iran, how that actually comes back to affect a certain region within the U.S. specifically for its preferred slate. So yeah, we'll be keeping an eye on that. And I think that is kind of a good place to leave it. Give us a few more topics to discuss next week, save those, and definitely we'll have, I'm sure, a lot more to discuss after Monday as well. So check out the show notes and we'll see you guys next week.
Alex, thanks for having me. Good to be back.
Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.